Imagine turning every dollar of your home loan into a powerful investment tool that works twice as hard for your future. What if I told you that thousands of Australian homeowners are already doing exactly that without taking on excessive risk? Hi everyone, Kim here from Duo Tax. There's a smart, simple strategy that could shave years off your mortgage, save you thousands on taxes, and help you build a profitable property portfolio all at the same time. Sounds too good to be true, right? But it's real. If you're a homeowner ready to slash your mortgage and pay less tax, debt recycling could be the secret weapon you've been missing. The biggest myth? That debt recycling is too risky. The truth is, when done the right way, it's one of the safest and most effective ways to grow your wealth. Today, I'm going to break down exactly what debt recycling is, and it might just be the game changer you've been looking for. Let's get started. What exactly is debt recycling? It's a strategy that converts your boring, non-deductible home loan into a tax-deductible investment debt that can actually work for you instead of against you. Have you ever wondered why some property owners seem to build wealth so much faster than everyone else? Or why high-income earners get to enjoy tax benefits that seem out of reach for the average Australian? The truth is, there's this financial strategy hiding in plain sight that can help pay down your mortgage faster while simultaneously building an investment portfolio. And the best part? It doesn't require a finance degree to understand. Here in Australia, the interest on your home loan isn't tax deductible because your family home isn't considered an investment. But the interest on loans used for investments is tax deductible. Debt recycling takes advantage of this difference. Let me break it down for you. Imagine you've been paying off your mortgage for a few years and have built up some equity in your home. With debt recycling, you take some of that equity, invest it in income-producing assets like shares or an investment property, and there you have it. The interest on that portion of your loan now becomes tax deductible. You've essentially recycled your non-taxable debt into taxable debt. Let's make this super concrete with a simple example. Say you pay down a decent chunk of your $500,000 mortgage and now have $200,000 in equity. With debt recycling, you could draw out, let's say, $50,000 of that equity and invest it into shares or another income-producing asset. Now, here's where the magic happens. The interest on that $50,000 is now completely tax deductible. Plus, any income from your investments can be used to pay down your remaining non-deductible home loan even faster. Think of it like this. You're putting your home equity to work twice. Once as an investment that grows over time, and again as a tax deduction that puts money back in your pocket each year. And the best part, you can repeat this process over and over as you build more equity, gradually converting your entire mortgage into tax-deductible debt while building a solid investment portfolio. Pretty clever, right? Before you get too excited, debt recycling isn't for everyone. You'll get the most benefit if you own property with some equity in it. Obviously, you need that equity to recycle in the first place. Are in a higher tax bracket. The higher your income, the more value you'll get from those tax deductions. Have a stable income and good cash flow because you'll be taking on investment debt. You need to be confident you can meet all your repayments. And let's be honest, you also need to be comfortable with a bit of risk because while your home loan might feel safe and familiar, investments come with their own set of risks. Speaking of risks, let's talk about the potential downsides. First, market volatility. When you invest borrowed money, you're exposed to market ups and downs. If your investments perform poorly, you could end up with debt but diminished assets. Then there's interest rate risks. If rates rise significantly, your investment loan repayments could increase, putting pressure on your cash flow. Remember that callback to risk I mentioned earlier? This is why debt recycling isn't for everyone. You need to have the financial stability to weather these potential storms. If you're still with me and thinking this could work for you, Here's how to get started. Chat with a financial advisor or accountant who specializes in this strategy. Seriously, this isn't a DIY project for most people. Next, you'll need to set up the right loan structure. This might mean refinancing or establishing a line of credit against your home. Then, start small. You don't have to recycle your entire available equity at once. Begin with an amount you're comfortable with and see how it goes. When you invest, focus on income-producing assets. Remember to get those tax deductions. Your investments need to generate income. And finally, keep meticulous record. You'll need to clearly track which portion of your debt is for investment purposes to claim those tax deductions correctly. One last thing to remember, debt recycling is a long-term strategy. It's not about making a quick buck. It's about systematically building wealth over time. Think of it like actually recycling for the environment. One plastic bottle doesn't make a difference, but consistently recycling over years creates significant impact. The same goes for debt recycling. The power is in the consistency and the compounding effects over time. And just like we talked about at the beginning, the beauty of this strategy is that it helps you achieve multiple financial goals simultaneously, paying off your home loan, reducing your tax bill, and building an investment portfolio. That's debt recycling explained in a nutshell. It's a powerful strategy that can help turn your biggest debt into your biggest wealth building tool. Is it right for you? Only you and your financial advisor can decide that. But now at least you understand how it works and can make an informed decision. And there you have it. I hope this video has given you a clear understanding of how debt recycling works and the steps you can take to start implementing it. If you've found this explanation of debt recycling helpful so far, I've got another video that goes deeper into negative gearing strategies for property investors. Check it out after this one to see how these two strategies can work together to fast-track your wealth building journey. If you found this video useful, subscribe and click on that notification bell to continue getting the latest tips on building wealth.